So here's something you probably didn't know about the world of corporate finance. When a company decides to go public, to sell its shares on the stock market for the first time, it has to file something called an S-1 prospectus with the Securities and Exchange Commission. That's the government body that oversees financial markets in the United States. These documents are, historically speaking, some of the most aggressively boring things ever put into writing. They are drafted by corporate lawyers for other corporate lawyers in a style specifically engineered to ensure that no human being ever accidentally enjoys reading them. But 2 days ago, SpaceX filed its paperwork to go public, and the moment you start reading through it, one thing becomes absolutely clear. This is not your typical legal disclosure. For starters, the document opens with 14 pages of photographs. Not charts, not tables, photographs of rockets and satellites, which honestly reminded me of another famously unusual prospectus, the one filed by WeWork back in 2019. That document opened with the line, and I am quoting directly here, "We dedicate this to the energy of we, greater than any one of us, but inside each of us." That filing was later described by financial analysts as one of the worst initial public offering submissions in the entire history of Wall Street. The SpaceX prospectus is similarly unconventional, though I will say the rockets are considerably more photogenic than WeWork's community photographs ever were. But it's not just the visuals that make this document unusual, it's the language. There are phrases in this filing that I am fairly confident have never appeared in a Securities and Exchange Commission document before in the history of American financial regulation. Under the Business Strategy section, right there alongside perfectly standard disclosures about lease agreements and accounting standards, the management team explains that the company's primary objective is, and text. So here's something you might not know about the financial world. When a company wants to go public, meaning it wants to start selling shares to regular investors on the stock market, it has to file a document with the Securities and Exchange Commission. This document is called an S-1 prospectus. And historically, these things are about as exciting as reading the terms and conditions on a software update. They are written by corporate lawyers for other corporate lawyers to make absolutely sure that no one involved in the process is ever accidentally entertained or inspired by anything they read. But 2 days ago, SpaceX filed its paperwork to go public, and within the first few pages, it became unmistakably clear that this was not going to be your standard legal disclosure document. For starters, the filing opens with 14 pages of photographs, beautiful, dramatic photographs of rockets and satellites. Now, this immediately brought to mind another famously unconventional prospectus, the one filed by WeWork back in 2019. That document opened with the line, "And I promise this is real. We dedicate this to the energy of we, greater than any one of us, but inside each of us." That filing was later described by financial analysts as one of the worst initial public offering filings in Wall Street history. The SpaceX prospectus is similarly unconventional, though I will say this, rockets are considerably more photogenic than WeWork's community space photographs ever were. But 2 days ago, SpaceX filed its paperwork to go public, and within the first few pages, it became unmistakably clear that this was not going to be your standard legal disclosure document. For starters, the filing opens with 14 pages of photographs, beautiful, dramatic photographs of rockets and satellites. Now, this immediately brought to mind another famously unconventional prospectus, the one filed by WeWork back in 2019. That document opened with the line, "And I promise this is real. We dedicate this to the energy of we, greater than any one of us, but inside each of us." That filing was later described by financial analysts as one of the worst initial public offering filings in Wall Street history. The SpaceX prospectus is similarly unconventional, though I will say this, rockets are considerably more photogenic than WeWork's community space photographs ever were. Beyond the pictures, the document is packed with phrases that I am fairly confident have never appeared in a Securities and Exchange Commission filing before. Under the Business Strategy section, right there alongside the perfectly standard disclosures about lease agreements and accounting standards, The management team explains that their primary objective is to, and I quote, extend the light of consciousness to the stars. That phrase appears not once, not twice, but 10 separate times throughout the filing, so it was not a typo. It was a philosophical commitment baked into a legal document. Investors are also formally warned in writing that, and again I quote, we do not want humans to have the same fate as dinosaurs. Which is fair enough, I suppose. It is the kind of sentence that makes you genuinely curious about what the risk disclosure section is going to look like. You go in expecting boilerplate language about interest rate fluctuations and currency exposure, and instead you get existential warnings about mass extinction. The document then lays out a remarkable list of future business lines that read less like a corporate strategy and more like the plot summary of a science fiction novel. These include long-haul point-to-point terrestrial travel, which, if I'm reading this correctly, means traveling from one city to another on Earth, but in rockets instead of airplanes. It also includes in-orbit manufacturing, yes, building things while physically in orbit around the Earth. Then there is passenger and cargo transportation to the Moon and to Mars, manufacturing and energy production on the Moon and on Mars, and, perhaps most ambitiously of all, asteroid mining. Because apparently, why go through the trouble of extracting resources from the ground here on Earth when you can chase down a hurtling rock through space in the hope that it contains something useful? Now, here is a fascinating detail about the language inside this document. The abbreviation for artificial intelligence appears over 200 times throughout the filing. The word consciousness appears 10 times. The word profit appears somewhat less frequently than either of those. Make of that what you will. What we are looking at is quite possibly the most extraordinary document in the entire history of American securities regulation. And today we are going to go through it carefully, because every single thing I'm about to tell you, no matter how strange or improbable it sounds, comes directly from the filing itself. Now, if you have been following SpaceX over the past 2 decades, you probably think of it primarily as a rocket company. That makes sense. It builds rockets, it launches rockets. It has become the dominant launch provider on the planet. In more recent years, with the explosive growth of Starlink, you might have updated that mental model to something like a satellite internet company. But if you sit down and actually read this initial public offering prospectus, you are in for a genuine surprise. According to the document, SpaceX is now, apparently, an artificial intelligence company. The filing states that 93% of the company's total addressable market is attributed to artificial intelligence. And when you look at the capital expenditure breakdown, meaning where the money is actually being spent, roughly 60% of all spending is currently going into artificial intelligence infrastructure. Not rockets, not satellites, artificial intelligence. The prospectus divides the business into 3 segments: space, connectivity, and artificial intelligence. Here is how those 3 segments performed in the first quarter of 2026. The space division, the part that actually designs, builds, and launches rockets, lost $662 million. The connectivity division, which is Starlink, turned a profit of $1.1 billion. The artificial intelligence division lost $2.5 billion in just 3 months. 3 months. So let us be clear about the financial reality here. The only division that actually makes money is the satellite internet business. Everything else is losing money. When Elon Musk describes SpaceX as an artificial intelligence company, what that really means in practice is that the one business unit that actually works, Starlink, is subsidizing a money-losing artificial intelligence venture. And while that is happening, the company is simultaneously trying to convince public market investors that the money-losing artificial intelligence venture is the primary reason the entire company is worth $1.75 trillion. If we set aside the poetic language about extending consciousness to the stars and focus purely on the income statement, the cold hard numbers, the financial picture of SpaceX is, to put it gently, bracing. In 2025, the company generated $18.7 billion in revenue. Now, $18.7 billion is genuinely a lot of money, but at a proposed valuation of $1.75 trillion, SpaceX is asking investors to value it at almost 100 times its annual revenue. To put that in perspective, if SpaceX were dropped into the Standard & Poor's 500 index today, it would rank as the 7th largest company by market capitalization. But if you ranked it by actual revenue, it would not even crack the top 200. It would be sitting somewhere down near Kellogg's, yes, the company that makes Fruit Loops breakfast cereal. The point is obvious but worth making. Unlike Kellogg's, SpaceX is not profitable. Space exploration turns out to be a considerably tougher business than breakfast. Last year, SpaceX posted a net loss of $4.94 billion. What makes that number particularly striking is the context behind it. Starlink actually generated $4.4 billion in operating profit during that same period. That means the rest of the business, rockets, Starship development, artificial intelligence infrastructure, collectively consumed more than $9 billion in a single year. Think of Starlink as a very successful lemonade stand, and the rest of the company as a construction project next door that keeps raiding the cash register. Since its founding, SpaceX has accumulated over $37 billion in total losses. That is more than any other company in history has ever lost before going public. And there are no signs of that cash burn slowing down. Capital expenditure reached $20.7 billion last year. That is a 5-fold increase compared to 2023, driven by Starlink expansion, Starship development, and artificial intelligence infrastructure spending. To fund all of this, the company is carrying $29 billion in debt. That includes a $20 billion bridge loan that was taken out in March of 2026, just 8 weeks ago. So when investors hand over $75 billion in this initial public offering, a meaningful portion of that money is not going to orbital data centers or a Mars colony. It is going straight back to the banks that lent SpaceX money 8 weeks before the stock market debut. Now, to be fair, the company is growing, and growing fast. Revenue is up somewhere between 33% and 43% annually, which is genuinely impressive by any measure. But that growth is coming almost entirely from Starlink, not from the artificial intelligence business. And even that growth comes with an important caveat. Starlink's average revenue per user has actually fallen by around 18% since 2023. The company has been discounting its subscription prices aggressively in order to drive up subscriber numbers ahead of the initial public offering, essentially making the business look bigger before the cameras start rolling. Back in April of 2018, Gwynne Shotwell, the president of SpaceX, stood on a TED stage and made a promise to the world about what this company was going to become.
So here's a prediction that was made with a straight face and a microphone. Within a decade, people would be hopping on 30-minute rocket flights from New York to Shanghai.
These rockets, we were told, would go head-to-head with long-haul airlines, running up to 10 flights per day. That decade ends in under 2 years, and right now, there is no commercial commuter rocket. There is no working prototype ferrying business travelers across the Pacific. There is just the ticking clock and the uncomfortable reality that nobody has yet figured out how to safely replace the jumbo jet with a reusable ballistic missile. One that, by the way, would require every passenger to endure 3 times the force of gravity at takeoff. That is 3 Gs. For context, that is roughly what fighter pilots experience during aggressive maneuvers. It is not what most people expect from a Tuesday morning commute to a board meeting. Now, if you were paying close attention earlier in this episode, you might remember a phrase that appeared in the investment prospectus: long-haul point-to-point terrestrial travel. That phrase is still in the document. It is still being pitched to investors as a future revenue stream. And yet there is no commercial rocket service, no timeline for one, and fewer than 2 years left before that bold public prediction officially expires. But point-to-point rocket travel is not the only line item in the column of businesses that do not yet exist. The prospectus also lists payment processing as a future revenue opportunity. You might be wondering what a rocket company has to do with payment processing. The answer involves Twitter, rebranded as X, which Elon Musk has described as an everything app, a platform he has wanted to turn into a full financial services ecosystem for several years. X has managed to secure money transmitter licenses in a handful of states across the United States, but it does not have a functioning payments product, not one that real users are actually using. So SpaceX, the rocket company, is now partly in the business of filing regulatory paperwork with the Nevada Department of Business and Industry, all in pursuit of the dream of someday processing an $8 peer-to-peer payment on a rocket company's social media platform. That is the vision. That is the revenue stream being pitched. Zoom out and the numbers get truly staggering. SpaceX claims its total addressable market is $28.5 trillion. Let that land for a second. That figure is larger than the entire gross domestic product of the United States, and the vast majority of it is built on businesses that do not currently exist. As the Financial Times' Lex column pointed out, the market has never before had to price a stock this speculative at this scale. That observation is probably worth keeping in the back of your mind as we work through what is actually in this document. Here is where things get really interesting. According to the prospectus, enterprise applications of artificial intelligence account for up to 80% of SpaceX's claimed total addressable market. The idea is that large corporations will pay to use Musk's artificial intelligence tools to boost their productivity. If you then fold in consumer artificial intelligence products, the total artificial intelligence share of the claimed addressable market climbs to 93%. 93%, which means, in practical terms, that 93% of the company's claimed value is essentially Grok, that is Grok, the artificial intelligence model developed by xAI, Musk's artificial intelligence company. Now, I want to be careful here because 80% of $28.5 trillion is an almost incomprehensibly large number. So it is genuinely worth asking, which major enterprises are currently using Grok? And from everything that is publicly documented, the primary use cases for Grok appear to be fact-checking posts on X and generating non-consensual nude images, the latter of which has triggered regulatory investigations in Spain, France, and the United Kingdom, and at least one ongoing lawsuit. That is not exactly the enterprise productivity pitch you would expect to anchor a multi-trillion-dollar valuation. The prospectus itself effectively concedes that the enterprise artificial intelligence market is dominated by OpenAI, Anthropic, and Google. Grok, SpaceX's own artificial intelligence product, holds a market share of roughly 3.4%. According to Bloomberg, SpaceX's own engineers have been slow to adopt Grok for technical work because it simply underperforms the competing tools that are already out there. Then, just last month, Musk himself acknowledged that Grok's artificial intelligence code would need to be rebuilt from scratch, and this came shortly after he sold xAI to SpaceX for $250 billion. His proposed solution to Grok's weakness in coding was to try to acquire Cursor, the tool his own engineers were actually already using, for $60 billion, with a $10 billion break fee attached if the deal falls through. So, to recap, the company whose artificial intelligence product supposedly represents 93% of its total addressable market has a flagship artificial intelligence tool that its own engineers will not use, and is now spending $60 billion trying to buy a competitor just to get the thing to work. SpaceX's near-term artificial intelligence revenue story rests heavily on a $15 billion a year deal to rent computing capacity, graphics processing units, the chips that power artificial intelligence workloads, to Anthropic. Anthropic, notably, is one of the very competitors whose success is the clearest evidence that Grok is losing the artificial intelligence race. Think about what that means structurally. If SpaceX were genuinely going to be a dominant artificial intelligence company, it would need that computing power for its own models. Renting it out to a rival is not the move of a company that believes it is going to win. Here is a useful analogy. If Volkswagen were renting out all of its car factories to Toyota, would anyone still describe Volkswagen as being in the car business? And here is the more pressing problem. That $15 billion a year contract represents roughly 40% of SpaceX's projected near-term revenues, and Anthropic can cancel it with just 90 days' notice. 90 days. One fiscal quarter. SpaceX's entire artificial intelligence business model right now is renting graphics processing units to a competitor on terms that can evaporate in 3 months. If SpaceX's total addressable market is $28.5 trillion and 93% of that is artificial intelligence, then by SpaceX's own internal logic, the leading artificial intelligence companies must be worth vastly more than SpaceX itself. Anthropic's quarterly revenue is already roughly double SpaceX's entire artificial intelligence segment revenue. Both Anthropic and OpenAI are reportedly preparing for initial public offerings at valuations of approximately $1 trillion each. And yet SpaceX is seeking a valuation of $1.75 trillion based on a market that its own direct competitors are clearly winning. Now, if you have ever found yourself wondering exactly who has been buying the Tesla Cybertruck, because that is a question a lot of people have had, the SpaceX prospectus finally provides a partial answer. It turns out that SpaceX was buying them. According to the filings, SpaceX purchased $650 million in goods from Tesla last year. That figure included $131 million spent specifically on Cybertrucks, all purchased at full retail price with no volume discount whatsoever. That is notable, given how much difficulty Tesla has had moving those vehicles off lots. Working out the math, that comes to roughly 1,500 trucks. At one point during the fourth quarter of 2025, SpaceX single-handedly accounted for 18% of all Cybertruck registrations in the entire United States. Using shareholder money from one company you control to prop up the sales figures of another company you control, right before both companies face major financial events, is, to put it gently, generally considered to be not ideal corporate governance. There is also a small but curious accounting discrepancy worth flagging. SpaceX reports purchasing approximately $650 million in goods from Tesla last year. Tesla's own filings report selling $573 million in goods to SpaceX. That leaves a gap of $77 million. Somewhere between Austin and Boca Chica, $77 million appears to have fallen off the back of a truck, presumably a Cybertruck. But a few thousand overpriced pickup trucks are actually the least of the related party concerns buried in this document. Antonio Gracias is a long-standing ally of Elon Musk and a sitting member of the SpaceX board of directors. He also runs a private investment firm called Valor Equity Partners. According to the initial public offering prospectus, SpaceX and xAI are carrying more than $20 billion in artificial intelligence infrastructure lease obligations tied to agreements with entities connected to Valor. Some of these deals are structured as what accountants call failed sale leasebacks. Here is how a normal sale leaseback works. A company sells an asset to an investor, receives cash up front, then leases the asset back, and in doing so, removes it from its balance sheet. Clean and simple. When the transaction fails to qualify as a genuine sale under accounting rules, however, the asset stays on the books, and the associated payment obligations get recorded as debt instead. The practical effect is that SpaceX is carrying billions of dollars in obligations to a firm run by one of its own board members, sitting on its balance sheet as debt. It is considered good practice, basic good practice, for board members not to have $20 billion worth of high-interest financial arrangements with the company they are supposed to be independently overseeing. And this is not without historical precedent in this particular universe. Back in 2016, Elon Musk used Tesla's shareholder money to acquire Solar City, a struggling solar energy company that he also chaired and partly owned. To help justify the deal during acquisition negotiations, he staged a public demonstration of SolarCity's solar roof tiles. Those tiles were later found by a Delaware court to have been entirely inoperable and nowhere near ready to go to market at the time of the demonstration. So let's talk about what happened in Delaware, because the whole SolarCity saga tells us a lot about how Elon Musk approaches conflicts of interest, and more importantly, where he chooses to do business now. The Delaware Court of Chancery reviewed that entire SolarCity transaction under its strictest possible standard of legal scrutiny, and the court did not hold back. It described the acquisition process as deeply flawed and specifically noted Musk's apparent inability to even acknowledge that he had a clear and obvious conflict of interest. He was simultaneously the chief executive of Tesla and the chairman of SolarCity, the company Tesla was buying. That's not a subtle conflict. That's about as textbook as it gets. And yet, here's the twist, the court found the deal entirely fair anyway. Why? Largely because 85% of Tesla's shareholders had voted to approve it, and Tesla's stock went up afterward. So the judge let the deal stand. The only real consequence for Musk was that the court declined to award him his legal costs. In the world of the Delaware Court of Chancery, that's the equivalent of a strongly worded letter, a slap on the wrist with a velvet glove. After that, Musk got into a broader dispute with Delaware over his Tesla compensation package, a massive pay deal that was later struck down. And so he made a decision that tells you everything about how he thinks about legal exposure. He reincorporated Tesla in Texas. He then completed a structurally similar acquisition, this time merging his artificial intelligence company, known as xAI, with SpaceX, but now in a state with dramatically weaker securities laws. Let's break down what that actually means in practice, because the contrast with Delaware is striking. In Texas, if you want to bring what's called a derivative lawsuit against SpaceX, meaning a shareholder suing on behalf of the company, you must own at least 3% of the company. Sounds like a modest threshold, right? At SpaceX's current valuation, 3% works out to approximately $52 billion worth of stock. So unless you happen to have $52 billion sitting around in SpaceX shares, you simply cannot bring that kind of case. The door is functionally closed. But let's say you somehow cleared that bar. You'd then need to prove not just that someone breached their fiduciary duty, which is the standard in Delaware, but specifically that there was fraud, intentional misconduct, or a knowing violation of law. A conflicted transaction, even one with absolutely no independent oversight, does not automatically meet that standard in Texas. You'd need to find the smoking gun. And here's where it gets really clever. If you went looking for the internal emails and text messages that might help you prove fraud, the same kind of internal communications that shareholders used so effectively in the Delaware proceedings, Texas corporate law now explicitly excludes emails and text messages from shareholder document requests. That's not an accident. That's the door being locked and the key thrown away. To put a bow on the regulatory environment in Texas, when Tesla reincorporated there, Governor Greg Abbott personally posted on social media to congratulate Musk and wish him well. That gives you a pretty reasonable sense of how the oversight landscape looks. The lesson Musk appears to have drawn from the SolarCity experience is not, I should avoid doing conflicted acquisitions in the future. The lesson is, do them somewhere with friendlier courts. Now, who actually benefits from the xAI and SpaceX merger? It's not the SpaceX engineers working around the clock trying to figure out how to get humans to Mars. The clearest beneficiaries are the venture capitalists and the investment banks, including Morgan Stanley, who found themselves stuck holding billions of dollars in what's called underwater debt from Musk's chaotic and heavily leveraged buyout of Twitter. Thanks to the xAI and SpaceX merger, those lenders have been made whole, receiving SpaceX equity in exchange. And that happened conveniently, almost suspiciously conveniently, just before what is expected to be the largest initial public offering in history. Speaking of that initial public offering, let's talk about how the investment banks are competing for a piece of it, because this part is almost too strange to believe. Historically, investment bankers won mandates on big deals by demonstrating deep sector expertise, long-standing advisory relationships, and a willingness to work extraordinary hours. It was considered a serious, dignified profession. The first crack in those standards, by some accounts, came in 2007 when Goldman Sachs bankers pitching for the Lululemon initial public offering mandate showed up to the meeting, led by David Solomon, also known by his disc jockey persona as DJ DSOL, dressed head to toe in Lululemon athletic leisure wear. And look, I want to be transparent here. That particular slip in professional standards may well have been the event that triggered the global financial crisis that very same year. Correlation, causation, you decide. But that was then. This time around, the person who secured the lead left position on the largest initial public offering in history did so by having staffers help him send Elon Musk a direct message on the social media platform formerly known as Twitter. He then boasted about this to the press. That's how Goldman Sachs got the top spot. Morgan Stanley, which had spent years collectively cultivating a relationship with Musk through their technology banker Michael Grimes, is listed as co-lead. Their name appears second, directly after Goldman Sachs. And apparently, Morgan Stanley was so furious about their placement that they forced SpaceX to explicitly clarify in the term sheet that the ordering is purely alphabetical. Just so everyone knows, it's the alphabet, not a ranking. In total, 23 banks have crammed their names onto the cover of this prospectus. The fees involved represent the most lucrative Wall Street initial public offering payday in history. And there's a darkly funny detail here. The only real evidence of enterprise adoption of Musk's artificial intelligence product, known as Grok, may well be the millions of dollars in software licenses that Musk is apparently requiring his lead initial public offering banks to purchase. Nothing says genuine market demand like mandatory licensing agreements with the people who desperately want your business. All of this brings us to the corporate governance structure of SpaceX itself, which is, without exaggeration, perhaps the most heavily fortified concentration of control ever brought to American public markets. The company will use what's called a dual-class share structure. Regular investors, the people buying shares in the initial public offering, will receive Class A shares, each carrying 1 vote. Elon Musk receives Class B shares, each carrying 10 votes. Even though Musk owns approximately 41% of SpaceX, he will control more than 85% of the total voting power. What that means, practically speaking, is that shareholders cannot fire him. Not ever, no matter what happens. On top of that, the company has placed specific limits on how shareholders can even file legal challenges. SpaceX writes directly in the prospectus, with remarkable candor, that this structure will, quote, limit or preclude your ability to influence corporate matters and the election of our directors. They're telling you up front. And then there's the index inclusion angle, which is subtle but enormously consequential. Musk reportedly convinced the NASDAQ exchange to change its index inclusion methodology specifically to win this listing, which means SpaceX will be fast-tracked for inclusion in the NASDAQ 100 index. This is a massive deal. The NASDAQ 100 is tracked by over $600 billion of passive investor money. Think index funds, pension funds, the retirement savings of tens of millions of ordinary people. By fast-tracking SpaceX into the index, countless passive investors will become what are called forced buyers of the stock almost immediately, long before there has been any serious price discovery. Before anyone really knows what this thing is worth, enormous amounts of ordinary people's money will be automatically flowing into it. And those investors will own shares in a company that burns through cash heavily, where they have essentially no voting power and no meaningful legal recourse against management. But Musk didn't stop there. The filing reveals the creation of a new class of shares, Class C shares, which carry no voting rights whatsoever. These exist specifically so that SpaceX can use them to acquire other companies in the future without ever diluting Musk's voting power. It's a mechanism for permanent, self-reinforcing control. And if Musk ever decides to step down, he can place his supervoting shares into trusts and pass them on to his children. Dynastic control, the kind of thing you'd associate with a medieval monarchy, now written into a prospectus for a 21st century technology company going public on an American stock exchange. Now let's get to Musk's compensation package, which has received a lot of attention, and for good reason, though perhaps not always for the right reasons. You've probably seen the headlines. Musk is receiving 1 billion performance-based restricted shares, and these shares only vest when SpaceX establishes a permanent human colony on Mars and hits a market capitalization of $7.5 trillion. The prospectus itself explicitly describes the achievement of those milestones as, and this is a direct quote, improbable. Now, this is not a sudden burst of honesty from SpaceX management. It's actually an accounting maneuver. Under standard accounting rules, if the company admitted it was probable that Musk would receive those shares, they would have to record the full value of the award as an expense on their income statement today, potentially hundreds of billions of dollars. By categorizing the grant as improbable, it gets booked at zero cost. Clever. But here's where it gets truly extraordinary. Thanks to an analysis by law professor Ann Lipton, Musk doesn't actually need to achieve any of those seemingly impossible milestones to benefit from these shares. He gets the utility of them immediately. He can vote those shares today. He can collect dividends on them today. And with the approval of a board that he entirely controls, he can pledge them as collateral for loans, giving him access to essentially tax-free cash today. He gets all the economic and voting benefits of owning 1 billion shares right now, based on a Mars colony that the company itself admits will probably never be built. And then there's possibly the most extraordinary single line in the entire prospectus. SpaceX writes that the company has, quote, renounced certain corporate opportunities that may be presented to Musk and certain of our directors and their respective affiliates, and that such persons may have no duty to present such opportunities to us. What that means in plain English is this. Nothing in SpaceX's corporate structure stops Elon Musk from setting up a separate private company tomorrow to pursue whatever the next big technology trend turns out to be, instead of doing it inside SpaceX, which would benefit SpaceX shareholders. If you're thinking that sounds familiar, remember when he was telling everyone that Tesla was an artificial intelligence company and then immediately started xAI as a separate, privately held competing venture? And here's where the risk of investing in a private company really comes into sharp focus. As one analyst put it, public shareholders in SpaceX will have no votes that matter, no ability to sell their shares at a fair price discovered through normal open market mechanisms, and no ability to sue the company for wrongdoing. No votes, no sales, no suits. 3 strikes, and you're just along for the ride. Now, there is one technology at SpaceX that everything else in this story depends on. Not the artificial intelligence systems, not the satellite internet business, not even the Mars colony. One rocket. Starship, the largest rocket ever built, is supposed to be the key to absolutely everything. Cheaper launches, bigger next-generation Starlink satellites, orbital data centers, a city on Mars, and those critical National Aeronautics and Space Administration contracts. Without Starship delivering on its promises, the entire $1.75 trillion valuation story falls apart completely. It's like building a skyscraper on a foundation that hasn't been tested yet. Barron's, the financial publication, actually wrote that the Starship launch was a bigger deal for SpaceX than the initial public offering filing itself. Think about that for a second. A single rocket test outweighs the actual stock market debut in terms of importance. The latest version of the rocket was originally supposed to launch before the initial public offering filing. That launch got postponed. It was then rescheduled for the day after the filing. Nicki Minaj even showed up to watch. Yes, really. But there were technical difficulties and it didn't go ahead. According to reports at the time, they were planning to try again the following day. So we'll just have to see how that goes. Here's the uncomfortable truth. Starship hasn't worked yet. Not fully. It's still in what the engineers at SpaceX themselves sometimes call the rapid, unscheduled disassembly phase of development, which is a very entertaining way of saying it keeps blowing up. So far, it has yet to carry any meaningful cargo to orbit. The only thing that has technically made it to space on a Starship so far is a banana. An actual banana. And while that's a fun piece of trivia, it's not exactly a ringing endorsement for a $1.75 trillion company. As Barron's rightly pointed out, this upcoming launch really is going to matter enormously. The entire investment case is built around Starship achieving what SpaceX themselves describe as an insane flight rate, hundreds of launches per year, each carrying 200 tons of payload into orbit. To put that in perspective, that's more than double the capacity of any rocket currently flying. Starlink version 3 satellites, which are supposed to deliver 20 times the bandwidth capacity of current models, are simply too large to fit on any existing rocket. They require Starship. The orbital data center concept requires Starship to launch something in the region of 1 million satellites, and the Mars colony requires Starship to work reliably enough to transport 1 million people who, I suppose, genuinely want to go there. If Starship fails to deliver, if the flight rate ends up being half of what was promised, if reliability is lower than expected, or if the costs per launch come in higher, the entire valuation collapses. The $1.75 trillion number assumes Starship works exactly as advertised, on schedule, with no significant technical setbacks. And history, as anyone who has followed the aerospace industry knows, strongly suggests that rockets rarely work exactly as advertised. So what we have here is a company claiming to be worth $1.75 trillion, and that claim depends entirely on a rocket that has not yet figured out how to land without exploding. That is not a minor footnote. That is the central risk. Now, initial public offering prospectuses are legally required to tell investors precisely what the company plans to do with the money it raises. This is called the Use of Proceeds section. An analysis by Cape Fear Advisors points out just how hard you have to dig through this document, including deep into the footnotes, to get a full picture of how SpaceX actually intends to use the money from this offering. The initial public offering is expected to raise somewhere between $50 and $75 billion. But when you add up all of the financial commitments buried throughout the document, the company actually needs approximately $235 billion over the next few years. That's between 3 and 5 times the total amount the initial public offering would raise. What this tells us is that the initial public offering is not the finish line for fundraising. It's just the starting gun. Financial writer Matt Levine summed up the whole situation really well in his Money Stuff newsletter. He wrote, "If you are buying SpaceX stock because you want to tell Elon Musk what to do, stop. If you are buying SpaceX stock because you want exposure to the space and artificial intelligence business, but you have doubts about current management, stop. But if you are buying SpaceX stock because you genuinely like Elon Musk and you want to go along for the ride with him, yes, that's it. That's the actual investment thesis here. And if somewhere down the road you find yourself disillusioned, if you feel like the promises didn't pan out the way you expected, well, as Levine dryly observes, that's kind of his whole thing.